This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Traders are weighing dovish Fed commentary ahead of the Asia Open, with today's RBA decision also in focus. Japanese stocks are set to reopen after a holiday. Investors are also awaiting a rare briefing from top Chinese financial regulators on hopes of further economic stimulus. Plus, growing fears of a wider Middle East conflict after Israeli strikes kill hundreds in Lebanon. But Iran's president says he's prepared to de-escalate tensions.
And Heidi will continue to digest more Fed speak that we got overnight, with the Chicago Fed president really talking about being hundreds of basis points above neutral. That, he says, is likely to lead to many more rate cuts. And we had Raphael Bostic, for example, being a little bit more moderate in his stance that officials shouldn't really commit to a series of outsized rate cuts. But it was really that focus on the weakness of the labor market that had Neel Kashkari also backing another 0.5 percentage point cut. But take a listen to what exactly Austin Goolsbee had to say.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral, to try to hold the conditions where they are.
And Shery, of course, as a debate wages over where next and how fast for the Fed. It is all about central banks, right? We've also been keeping an eye very closely when it comes to the continued slowdown in the Chinese economy. And finally, the PBOC coming through with that 10 basis point cut to the 14-day reverse repo rate on Monday. In a lot of ways, this was kind of a long time coming, right? In a lot of ways, it seemed to be playing catch up. So the question is, what the market expectations adjust to next. Traders had been expecting the PBOC to trim that rate after the reduction in the 7-day repo rate back in July. So it is perhaps not kind of the strongest signal that we're seeing the PBOC really truly embarking on a fresh round of certainly, anything close to whatever it takes easing. But we could get a little bit more sort of information about that, a little bit more of strong signaling when it comes to this rare briefing between the PBOC, the CSRC and the NFRA all meeting today to talk about financial support for economic development. We'll be hearing potentially from Pan Gongsheng, the governor of the People's Bank of China, attending that briefing. The National Financial Regulatory Administration, as well as the Securities Administrator, I should say, will also be in attendance. And the other thing, of course, Shery, that we're watching out for is the RBA, perhaps, out of lockstep with the easing cycle that's begun for a lot of major central banks. We're expecting that the pause, to be continued today, Shery.
Yeah, we had the Aussies supported on the news of potentially more stimulus to come from China, of course, not to mention rising bond yields as well. Take a look at how Asian markets are setting up at the moment, because we also had the Japanese yen really treading water, because we have seen that strength after the BOJ policy decision last week. We saw a little bit more weakness, but Japanese equity markets are coming back online after holidays today. The offshore yuan holding at that 7 per dollar level. But take a look at how we set up on Wall Street, because we actually had a little bit of gains in the overnight session. But when you actually take out the tech mega caps, for example, and you have the equal weighted S&P 500, for example, that was at a record high. We also closed at a record high on the Dow. It's really been about trying to understand where the Fed is going, digesting Fed speak. We also had data showing that U.S. business activity expanded at a slightly slower pace, but we're talking still about robust numbers. So with this backdrop of more easing to come from the Fed, let's bring in our next guest, who's rotating into value on the expectation of not only the Fed, but really global rate cuts. With us now is George Marius, CIO and Global Head of Equities at Principal Asset Management. George, great to have you here in Tokyo.
Great to be here. Thank you.
And what a time to come here to Japan. We're still digesting what happened with the Fed. We're still digesting what's happening with the BOJ. But your expectation is that really those value stocks will do better from here.
And the reason is because of the Fed cuts. A significant cut, that 50 basis point cut that we saw last week, was the Fed responding to, trying to catch up to some of the economic data, the weakness that we're seeing in the U.S. That gives a lot of cover to central banks around the world to continue to cut, and also allows the Bank of Japan to potentially not be as aggressive in raising rates, but can allow their rate differential to essentially hang in there with the yen where it is, to not have to be so restrictive. So I think you've got coordinated monetary policy globally. We're seeing a lot of fiscal policy expansion, and it's a good time to think about the economy stabilizing and recovering over the next year.
It's been really interesting to see the action overnight because again, you take away the tech mega caps, you factor that out, and you have the equal weighted S&P 500 again at record highs. We've had this sort of dynamic for a while now. Is the growth in these mega cap tech stocks done?
Well, first of all, these are fantastic companies, extraordinarily profitable, multiple competitive advantages. But if you look over the last 2 years, their multiples have exploded well beyond what their earnings growth has come in. And so there is a bit of overextension. I think valuation is very stretched here. Could it get worse? It could. But it's hard to justify via fundamentals going forward, whereas that trade has been a very crowded, growthy trade, and it's left behind a lot more of the cyclical elements of the market. We're seeing the spread between growth and value at multi-decade wides. A very attractive time to look at a contrarian view. And when you think about economy stabilizing, the economic growth going, a lot of those more valuation discounted securities are economically sensitive and ought to grow at a pace that is significantly higher, not only than in the past, but actually track with the leading tech stocks.
George, I wanted to get your views on China because you talk about intriguing as being the way to describe risk-reward for Chinese equities. Is it intriguing enough to put your money down at this point? We have seen that rate cut to the 14-day rate by the PBOC, but that was largely really being seen as kind of catch-up and fully priced in by market expectations.
Heidi, I think it is. I think it is intriguing, and I think it's worth putting your money in there. Now, let me put up the caveat. It is, of course, risky. Everything's risky, but we know that there's a lot of opacity with respect to what we're seeing in China. There's a lot of geopolitical tension. But from my perspective, all of that's been known. That's been the case for a while. And what you're looking at now with respect to Chinese equities is a market that's substantially discounted relative to their global peers. It's trading at nearly 2/3 of a discount versus the U.S., just an incredibly substantial discount, even accounting for all of the risk that I just mentioned previously. And yet we're seeing corporate governance improve. You can invest in some very strong cash-generative companies. And then lastly, and as you're seeing it again this morning, we're seeing continued efforts by policymakers in China, whether it's on the fiscal or by the PBOC, to try to reinvigorate the economy. There's continued criticism over it not being enough. I think the continued efforts are a great sign of a desire to rehabilitate the economy. And I think it's again, it takes a little bit of a leap of faith, but I think it's a very intriguing time to invest in Chinese equities.
The never enough might feed into the view that policymakers acknowledge a certain level of an acceptable slowdown, right? That this is a structural slowdown after so many boom years of growth. So in that sort of slower growth for longer environment, what sort of opportunities would you be pinpointing?
So I think what you're looking at here is some of the companies that can grow irrespective of the economic environment. A lot of the technology giants that are highly cash generative, media companies that are highly cash generative. You have a significant number of companies in China that are generating double-digit free cash flow yields and that are going to continue to be able to grow in that way irrespective of the cyclical dynamics happening in China. In fact, ought to play well as the economy structurally changes. So tremendously discounted valuations, great companies that should grow over time. And then, frankly, we're seeing corporate governance improve dramatically. Companies are now issuing dividends, buying back stock, being much more forthright with respect to shareholder returns than we would have seen a decade ago.
There was, for a time, really a lot of concern about a potential yuan carry trade reversal, as we saw with the yen carry trades. Is there a concern at this point, given how much markets have priced in Fed easing, that structurally we might be at a shakier position?
So I think the yuan carry trade worry is a lot less concerning than the yen carry trade, right? I think what we're seeing is the PBOC probably looking for the Fed to cut so that they too can be very aggressive and stimulate the economy. I think a very different situation is happening in Japan, where you've had literally a decade of not only zero but negative interest rate policy that needs to get fixed. And so the Bank of Japan is confronting a different problem set. That problem set is, how do I get ourselves back into positive rates, positive yield curves? How do we help the demographics of our society generate more on their savings than we would have had before? It's a very different issue than the PBOC is facing.
George, really great to have you with us. George Myers is a CEO at Principal Asset Management. Well, Lebanese officials say more than 350 people were killed as Israeli forces pounded hundreds of what they say are Hezbollah targets across the country. Monday's escalation is stoking concerns about now a full-scale war in the Middle East. Bloomberg's Michael Heath joins us now with the latest, and this was seen as really one of the deadliest days of fighting that we've seen in, some 2 decades. These fears, we were talking earlier about this spiralling quite quickly, are pretty well founded.
Yeah, it looks like it. I mean, this represents escalation. Obviously, Hezbollah has fired back quite a few missiles. There were some Israelis injured as well. But Israel's really, it's pulling off the band-aid here in terms of the north and the Lebanese border. It's striking hard. It's targeting missiles. So what it says is missile silos and arms caches. It's trying to stop Hezbollah being able to keep raining missiles and other projectiles on northern Israel. And the basic idea is to try to get Israelis back into that area, excuse me, into their homes in northern Israel. So they're trying to degrade Hezbollah's its ability to attack Israel. The thing is that there's only so far you can sort of go with pinpoint strikes or air strikes. In the end, you tend to need ground forces to go in and clean up everything and try to get rid of those missile launches and that sort of thing. But Israel's been into southern Lebanon a couple of times, and it sort of has ended up as a quagmire. So they'd be very wary about that. But certainly it has all the makings of war now.
We've seen the US to send a small number of additional troops to the Middle East. I mean, what are allies feeling and thinking at the moment? Is there full support when it comes to this new phase of what we're seeing from Israel?
It's almost like they're out of the picture, Heidi. I mean, or sidelined, I think is perhaps a better way of putting it. I mean, the US didn't give any more details on the additional people they were sending out there. But they seem to sort of be out of the picture now because this is so fluid and it's moving so fast. And Israel does have quite a lot of solid ground here. I mean, it was warning people in southern Lebanon to move away from homes where there's arms caches or launches. Prime Minister Netanyahu himself directly warned southern Lebanese to take this seriously. And there were images on social media of a home being hit and then just multiple secondary explosions, which suggest that there were arms caches there. But at the moment, really the rest of the world is sort of looking on. I mean, we've had Iran's president sort of saying that he wants to put war aside or put the conflict aside. But really at this stage, it seems to have a momentum of its own.
Yeah, I mean, world leaders are gathering together at the UN General Assembly where the president of Iran spoke, right? So at this point, what can the international community do and what are the next steps?
Yeah, well, I mean, Iran's president, and in fairness to him, he doesn't have a lot of power. The arc of resistance, as it's called, Hezbollah, Hamas, the Houthis in Yemen, that's controlled by other areas, and there's the supreme leader in Iran. I mean, he made all the right sounds about everyone sort of taking a step back and not falling into war, and also wanting to resurrect this nuclear deal. But it's very hard to. It sort of almost sounds a bit disingenuous there. I mean, Iran does fund and arm all of these various groups that are engaged with Israel in this conflict now. So I think it has a pretty substantial say on what they do, irrespective of what he says. But as I was saying, there's a momentum of its own in this, and Hezbollah and Israel are sort of Hezbollah, I think, would like to sort of avoid an all-out conflict, but they're going to have to respond, and they're a very serious organisation. They basically control Lebanon. They're very powerful. They're battle-hardened. They fought in Syria during the civil war. A lot of their militants there. They've got a lot of arms. There is Iran's primary asset in terms of this arc of resistance. So I suspect that the world's just going to watch on. It might make the right noises, but we seem a long way from any sort of prospect of peace here.
Bloomberg's Michael Heath there, watching the escalating tensions in the Middle East. And coming up also on the Asia trade, we preview the RBA decision with Commonwealth Bank, who expects 125 basis points of easing by the end of next year. UBS Global Wealth Management joins us to discuss how a weaker dollar could benefit Asian equities. Plus, in today's Australia Ahead, we look at why big numbers of New Zealanders are looking to jump the ditch to their bigger neighbor. This is Bloomberg. The U.S. is seeking to ban the sale of or import of Chinese and Russian-made hardware and software for connected vehicles, citing national security concerns. For more, let's bring in our China correspondent, Min Lo. So, Min, what would be the impact of this?
Yeah, so the U.S. is trying to do two things here. One, it's seeking to ban those software used in automated driving. And secondly, it's looking to ban parts that are integrated into vehicle communication systems that enable things like Wi-Fi and Bluetooth in cars. And this applies not just to cars, but also buses and trucks as well. If enacted, the software ban will kick in by 2027 and the hardware ban by 2030. Now, the Secretary of Commerce, Gina Raimondo, was very clear. She said that foreign adversaries are now building the capability to remotely access cars for the purposes of mass surveillance and sabotage. She says these connected vehicles now have the ability to collect huge amounts of personal data, including audio and video recording, pattern of life analysis, geolocation, for instance, and in extreme cases, she says malicious access can even take control and shut down these vehicles. So she's clear that this is all about national security. It's not about economic and trade advantage, but it's undeniable that a side effect of this proposal would be to ban Chinese car makers from having a presence in the U.S. at all. It would ban the exports of Chinese cars from Mexico into the U.S. under the free trade agreement, the North America Free Trade Agreement, if they contain these software or hardware that are banned in the proposal.
We're also watching this story. China establishing a dispute panel successfully at the WTO to review whether the U.S. Inflation Reduction Act complies with international rules. According to Beijing, the U.S. is using climate change as a guise for protectionism.
That's right. This is actually Beijing's second attempt to establish this dispute panel, and they were successful this time. The first time they did it, they were blocked by the U.S. claiming that the Inflation Reduction Act, or IRA, is necessary for climate change. Now, this, by the way, is President Biden's flagship environmental and industrial policy, and it contains over $370 billion in climate provisions, including tax credits for electric vehicles and incentives for renewable energy projects, for instance. And China claims that it discriminates against Chinese products because of the domestic requirement rule. The U.S. calls this the single largest investment into climate change, but China calls it the single largest subsidy program ever. So the WTO now has the job of investigating whether the IRA is in fact violating international trade rules. And Washington has hit back, saying that Beijing is complaining to distract from its own unfair trade practices, which they say include weak environmental practices and forced labor as well.
Bloomberg's China correspondent Min Lo there. Another story that we're following this hour, Donald Trump says that if he returns to the White House, his first call will be to Chinese President Xi Jinping. He has accused Beijing of failing to honour an agreement that saw the US reduce some duties in exchange for China pledging to increase its purchases of US exports, including $50 billion in agricultural goods. The US presidential race has seen both Trump and Kamala Harris vow to take a tough stance against Beijing.
The first thing I'd do is my first call, I'm going to call up President Xi. I'm going to say, you have to honor the deal you made. We made a deal. You'd buy $50 billion worth of American farm product, and I guarantee you he will buy it 100%. He will buy it. Second thing I'm going to do is I'm going to say, you have to give the death penalty to your fentanyl dealers.
Trump also promised a 200% tariff on John Deere if the company moves production to Mexico. Deere has signaled upcoming layoffs in the US as it faces rising operational costs and declining demand. The world's top farm machinery maker is also acquiring land in Mexico to shift some production previously done in the US. Shery.
Haidi, Japan is demanding that China crack down on online hate speech after high-level talks following the murder of a Japanese schoolboy in China. For more, East Asia government editor John Herskovitz joins us now. And John, this issue has been brewing for days now after the death of a 10-year-old boy who was heading to school in Shenzhen. Tell us, what exactly does Tokyo want to see here?
Well, we've seen some engagement from Tokyo at the diplomatic level and governmental level. The most recent thing was the high-level talks in Beijing, where Japan asked for a crackdown on some of the internet inflammatory speech directed at Japan. At the United Nations, Japan's Foreign Minister Yoko Kamikawa met with her counterpart Wang Yi and asked for help in ensuring the security of Japanese nationals in China. We've seen Japanese companies advise their employees in China to be cautious, and there's just been a lot of concern about the Japanese community in China. In Japan, the reaction is much more passionate. People are really concerned about what's going on, probably much more so than the government has been in its contacts with the Chinese government.
There's always been historical territorial tensions between China and Japan, right? But we're now seeing, as you say, Japanese companies also warning their employees about safety in China. What's at stake here for Beijing?
Well, for China, it's really about the openness of the country, the ability to attract foreign investment and to attract foreign professionals, tourists coming into the country. And we've seen a rise in nationalism under President Xi Jinping. And some people are saying that this is a result of the nationalism that's taken to an extreme. China has downplayed this, said these are isolated incidents. They said that China doesn't profess hate in any way, shape, or form. But there has been very much this type of open questioning, these types of provocative statements that have come out towards Japan, towards Japanese, towards other nationals over the past several years. And it's been part of fostering a stronger image for China at home and for Xi Jinping's government.
Nationalism is a double-edged sword, right? It's not just love for your country, it also can foster xenophobia. These, as you say, is not the first time. This is not the first time. We have seen attacks on foreigners in the past in China.
That is correct. We've seen a few months ago there was a Japanese mother and child in Suzhou who were part of a knife attack. We've seen other foreigners also who have been part of this. We've seen detention of foreign executives. There have been detentions of foreigners accused of espionage by Beijing. And this has gone on for several years. And it's fostered concerns, and the Chinese government is trying to address these, saying that it's open for business, these are isolated incidents, investment should go into the country, but people are also voting with their feet. We've seen Japanese companies slow down or just freeze their investment in China, and there's concern in many parts of the world about putting money into the country.
Continue to watch the developments and fallout from this tragedy with the death of that schoolboy. East Asia government editor John Herskovitz here. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at that two-day chart when it comes to how Apple has been performing. We're seeing that decline there. You know, Friday was supposed to be a really buoyant day for shares of Apple, of course, set to be the big winner when it comes to the quarterly adjustment of major stock indexes. It did play out like that until about 10 minutes before the closing bell. And we are also seeing some of that continuation to speculation as to who was selling in the final minutes for it not to really benefit so much from those index changes.
Momentous as the recent decision to begin removing restriction from monetary policy was, taking that step does not lock us in a cadence for further moves. I think it's important that no one think that we're in a mad dash to get to some neutral level. Given the amount of uncertainty in the economy, being more patient will be valuable.
Atlanta Fed President Raphael Bostic there with a little bit of a more moderate stance than his peers like Austin Goolsbee and Neil Kashkari, who were really honing in on the weakness of the labor market, and the Chicago Fed president saying that the current rate was hundreds of basis points above neutral, and that likely means many more rate cuts over the next year. So investors were really trying to digest all of that Fed speak that we got overnight. U.S. futures under a little bit of pressure after the S&P 500 marginally rose. We're seeing Sydney futures down 0.1%, but this, of course, as we head towards the big RBA decision today, Heidi.
Yes, big, and yet, of course, we're all sort of moderating our expectations, right? No expectation that we're going to see any kind of, Fed-style jumbo-sized surprise or even any easing today. Take a look at what we're watching when it comes to Aussie bonds. We're heading towards that decision. Markets not pricing in a full rate cut until February 2025. Futures market pricing, very minimal, 3% chance of a cut today. And the earliest cut is really being priced in for February next year because quarter-on-quarter CPI is still hovering at high 3% levels. That is pretty far from the 2% target. So much of this is down to the housing crisis and the propping up that we see when it comes to dwelling price inflation. Let's get more perspective with Belinda Allen, who's a senior economist at Commonwealth Bank of Australia. So the House view when it comes to CBA is sooner than February, but you've actually pushed it out a little bit towards further into right at the end of the year. The disparity when you take a look at what the Fed is doing, what the RBNZ and other central banks are doing, seems ever starker now. Does that sway the RBA at all?
Look, that's a good question. We think the Reserve Bank will obviously be aware of what the Fed is doing, but the Reserve Bank here in Australia is very much running its own race based on the economic data here. And from their perspective, the economy is still performing fairly well, particularly the labour market, where we've seen only a modest loosening to date, very much in line with the Reserve Bank's expectations. Although I would note that at 4.2%, the unemployment rate here is actually the same as what we have in the US. So for the Reserve Bank, it very much comes down to uncertainty around inflation. Inflation remains persistently stubborn, according to them. Although there's a lot of uncertainty over the outlook, they do seem to be still maintaining their hawkish stance, although we do think it could be watered down a little bit at today's meeting.
There's also a lot of domestic political noise, right? You've got the Greens basically demanding that the government should be ordering for a rate cut, a hostile takeover of the RBA, if you will. This is obviously unhelpful when it comes to progressing central bank reform measures. Do you think the RBA at this point, it makes their job more complicated, the political element, or are they just blocking this out?
I think the Reserve Bank has always been very good at blocking out that political noise, as you did note that's what it is. I think they're very much focused on the job at hand. They've been very clear about their mandate over the last year or so since Governor Bullock did take charge. They're very much focused on bringing inflation down towards target. They continue to note the costs of high inflation for the whole of Australia, and they are aware that interest rates where they are now are obviously restrictive and impacting on parts of the household sector in a large way, but they're really just very much focused at the task at hand. We do think inflation can come down a little bit faster. As you did note in the introduction, we do still expect a rate cut before the end of this year, but it's very much going to come down to the data flow between now and that all-important December board meeting. And we really do need the labour market to loosen a little bit more, and also as we expect inflation to come in below the Reserve Bank's forecasts.
Another big political issue right now, of course, is migration when it comes to Australia. And we know the population growth has actually ended up being inflationary. If we see more restrictions on that side, what would be the long-term impact? And are there any implications for the RBA at this point?
Look, we do see the population growth rate starting to come down, particularly given the reductions in international student numbers as the government tightens up some of the way that students can come in and the numbers with that student cap starting next year. Overall, that's going to reduce the supply of labour. It is also going to take some of the demand out of the housing market. So we think net, there's a little impact in terms of the impact on inflation. In terms of economic growth, we know one of the key drivers of Australia's potential growth rate is population growth. So if that does start to come down, and if we don't get the improvements in productivity, which is very much needed for the Australian economy, potential growth in Australia will slow, and that's something the Reserve Bank will obviously look at over the longer term. That's obviously going to have implications for the neutral cash rate, which is still very much up to debate here in Australia. So really, I think the near-term implications are on the housing market, less labour supply. In the long term, very much down to lowering potential growth here in Australia and implications for the neutral cash rate.
What are the implications of the Stage 3 tax cut so far?
Look, very little. So we've released here at Commonwealth Bank, we've released data for July and August in terms of consumer spending. We don't think there's been any material lift in spending from those Stage 3 income tax cuts. And we do expect it's going to take interest rate relief before we do see an improvement in the consumer spending outlook. We've seen savings rates very low here in Australia over the past year or so. Pent-up savings, which we've obviously built up during the pandemic, are largely now exhausted. So we don't expect any real lift in consumer spending from these income tax cuts. And as I said, it's really going to take interest rate relief to see some improvements in the consumer, which is more likely a 2025 story. And really, that's where we're different from the Reserve Bank. We actually think the household consumption outlook's a lot softer than what the Reserve Bank is currently forecasting.
To that end, how much further strength do you expect in the Aussie dollar? Because I'm thinking, if we see more stimulus from China, if that economy, the economic recovery becomes, a little bit more solidified, and then that growing divergence when it comes to rates between the RBA and the rest of the world, not to mention what we see with bond yields, do you think it will get to a point where the RBA is less comfortable with the levels that we see in the Aussie dollar?
Look, I mean, they do monitor the Australian dollar in terms of what it means for the economy more broadly and the inflation outlook. The Aussie dollar is just under 69 US cents this morning. We do have it lifting closer to 72 US cents by the end of next year. It's very much driven by a US dollar story in terms of an improvement in the global economy, generally pushes the US dollar down and the Australian dollar up. That's very much our thesis of the outlook for the currency over the next year or so. Obviously, the biggest uncertainty this, as you said, is China. And if we do see further stimulus coming out of China, which is a possibility today with the announcement of that press conference, we could see that obviously lift the Aussie dollar depending on that announcement today, but only a small, modest lift in the Australian dollar between now and the end of next year.
It's interesting because one of the reasons, arguably, the RBA was sort of late off the mark was his concern over how much indebted households in Australia could take on rising rates and how quickly, right? That sort of mortgage cliff scenario hasn't quite played out. Has that surprised you?
The resilience of the household sector, I think, has been one of the more interesting stories to watch over the last couple of years. Given that large lift in interest rates here at the moment, Australian households are having to devote the highest share of their income to housing repayments on record. And I think that resilience has really come down to the performance of the labour market. So the unemployment rate has lifted, from a trough of around 3.5% to 4.2%. But the employment to population ratios are close to record highs. So more people are working. More people are working more hours, and that's obviously generated a lot of income for Australian households, which has meant that they've largely been able to get through the lift in interest rates, albeit they are making quite distinct choices over what they're doing in terms of their spending decisions, with a real cutback on discretionary items and also lower savings as well. So households have had to make difficult choices. We've obviously seen just a modest lift in arrears to date. So really the outlook from here in terms of the household sector very much comes down to the labour market. And that's, I think, where it is really important for the Reserve Bank. You don't want to wait till you get to full employment before you start easing interest rates, given the restrictive nature and the restrictive level that the cash rate is at this point.
Belinda Allen, really great to have you with us, a senior economist at Commonwealth Bank of Australia. You can, of course, turn to your Bloomberg for more on the RBA decision. You can get that at TLIV Go for commentary and analysis from Bloomberg's expert editors. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Japanese assets are setting up for the open. Of course, we're coming back from a long holiday weekend. We had seen the Japanese yen really range bound around that 143 level, perhaps a little bit stronger this week after losses following the Bank of Japan's policy decision of not moving in this meeting and not being in a rush to hike rates either. We're seeing the yen under a little bit of pressure against the U.S. dollar, but really not by much. Let's preview the market opens in Tokyo. Asia equities reporter Winnie Su joins me here in the Tokyo studio. So, range bound for the yen, small gains for global equities. What are we expecting for the open today?
Yeah, so Japan, we just came back from a holiday, like you mentioned, so it's going to take some time to play that catch-up from Friday and Monday's U.S. session. So we are going to see some strength in the Japanese market, but also the dovish press conference by Governor Ueda from the Bank of Japan's decision on Friday. That's also likely to be some tailwind for Japanese stocks, especially when he said that he needs, to also observe the financial markets condition. So these are likely to be some of the short-term boosts for Japanese stocks.
Yeah, what could be some of the risks, though?
Yeah, so the two big risks that we're watching, or we've been watching, is really the economic situation in the U.S. and also the yen. So JP Morgan was saying that the yen is basically the big theme here that we're seeing. But the negative impact is only going to be evident once we see the earnings from the second quarter. So we see the half-year earnings coming out so that we can understand how much of that impact is really from the Japanese yen. And they're saying that that impact can also come down to the full year earnings as well. So if we're seeing those impact on the full year earning, companies are likely to revise downwards for their earnings forecast. So that is also going to weigh on Japanese stocks when we look at the longer term. But we're not going to be able to see unless we are able to kind of see how it shows in the results. So that's going to take some time. However, I actually spoke to Man Group, the hedge fund, on Friday, right after the Bank of Japan's meeting. And they're saying that the 140 yen against the dollar is actually a way healthier level compared to 160 for Japanese stocks. Although we're going to see the negative influence on Japanese stocks if the yen continues to strengthen. But until the yen strengthens to 120 level, exporters are actually able to manage that level. So they're quite positive about how the current level of the yen being able to boost that reflationary story in Japanese market.
Yeah, we'll continue to be watching how the markets really react to whether we strengthen the Japanese yen from here. Asia equities reporter Winnie Su there. And of course, that conversation on the yen strength also really working itself into the strength of the Japanese economy and where the BOJ goes from here. The Japanese Prime Minister Fumio Kishida saying that his work on economic reforms has led to the highest wage increase in 33 years. Speaking at a Bloomberg event in New York, Kishida said that the positive results of these initiatives are evident in a wide range of data. He also said that Japanese economic policy is a work in progress, acknowledging the economy has suffered in the past.
Japan's economy has suffered. I have worked on the full range of economic policies during the past 3 years. The positive results of these initiatives are evident in a wide range of data, including the highest wage increase in 33 years. The Asset Management Forum will be launched by leading Japanese and U.S. asset management companies on October 3rd in Tokyo. The work, however, is still in progress.
Top executives at KKR and Blackstone say private equity is in its infancy in Japan and there's ample room for buyout firms to expand their presence. Blackstone President and COO Jonathan Gray spoke at that Bloomberg event in New York along with KKR Co-CEO Joe Bae.
We're quite bullish on Japan. I mean, Japan is a must-own country today for investors. The key, as my panelists have said, is the continuity of these reforms, the continuity of these policies. That's what investors really need as a foundation, right? Is stability, transparency, and continuity so they can invest for the long term in a country like Japan. But we're very, very bullish.
What are you, I mean, is it a crowded space for private equity at the moment in Japan?
I think there have been a lot of articles of the growing demand for private equity in Japan. But when you look at the US or you look at Europe, private equity in Japan, it's at its infancy, honestly. There are much fewer players, probably less than 1/10 of the competition that we face in other markets. So there's a lot of room to grow. The private equity industry will grow also as the capital markets in Japan continue to diversify. Japan today is very much a bank-led economy, right? The main banks in Japan, the regional banks. You don't have the same sort of capital markets in terms of the bond market, high yield market. That's going to be a huge enabler of private equity and the types of transactions we do. And private credit is a whole different asset class, which really doesn't exist in Japan today. So there are multiple legs, and you could see that could really accelerate the development of private equity over time.
John, do you agree with that? And do you worry about bidding wars if more players come in?
Well, there's always competition. You'd love to be in a market where there isn't, but we live in a world where people see opportunities. They get on planes, they build their offices on the ground. But I agree that relative to what we see in the U.S. and Europe, it's still early days in terms of private asset investing in Japan. And the number of players relative to the scale of the economy is still pretty small. So we think it's a pretty favorable dynamic as an investor. And it also feels like it's early days because these reforms have only been in place for a short period of time. And people are excited that the Japanese stock market is above the 1989 level. But think about where that is relative to other markets. And you think about the long-term potential. And you also think about Japan's strength in technology in the world we're moving into. So we have a lot of underlying bullishness around the economy. The fact that the market's opening up and there are a limited number of players on the ground, that all seems to us to be a very good dynamic. And so we want to deploy more capital, have more people there, and generate favorable returns. So it feels very good to us early days. And I would also say we hope these reforms stay in place and they continue.
Top executives from KKR and Blackstone speaking with our colleague Francine Lacroix in New York. We have more ahead on the Asia trade. This is Bloomberg.
About 45,000 dock workers at every major port along the U.S. eastern and Gulf Coast are threatening to strike next month, with talks that are stalemate since June. A stoppage could jolt the economy with supply chain disruptions and consumer discontent last seen during the pandemic, just weeks before the presidential election. One estimate says a week-long strike could cost the economy $7.5 billion. Boeing has offered its largest union a larger pay bump as it tries to overcome a strike that's shut down its aircraft manufacturing across the Pacific Northwest. For more, let's bring our Bloomberg senior aerospace reporter, Julie Johnson. Julie, so Boeing's union had begun these talks demanding a 40% increase in wages. Is 30% close enough?
That's the I don't know how many billions of dollars question this is, but it's multi-billion. I would say just based on the initial social media response, this is probably not enough to get it done, but it's definitely a step in the right direction from the perspective of members.
Boeing and the Machinists Union broke off the latest round of contract talks just last Wednesday, right? Did the sort of offer that we're seeing at the latest point address any of the main sticking points at all?
Yes, absolutely. Now, the union came back into the round of talks last week, and from what I've heard, drew a hard line, and were pushing again for this 40% pay raise. And they also wanted the pension to be reinstituted. So on the pay, Boeing is definitely moving into the direction where people start to get very interested in the deal. The pension part of this is going to be very interesting to watch and a real stickler for both sides, because the union membership, I think, is not unified in the desire to reinstitute the pensions. That's more something sought by longtime workers, where younger workers care more about the cash in their pockets.
So what happens if the workers don't accept this latest deal? I mean, Boeing gave them until midnight Friday.
Yes, absolutely. And we're still waiting to hear from the union, by the way. We don't know if the union is even going to schedule a vote on this before Friday. So that will be an interesting watch item. But if this gets voted down, then it's sort of, business as it has been for the past week or two. The strike continues. The pain grows on both sides. And at some point, someone's going to blink.
Bloomberg senior aerospace reporter Julie Johnson there with the latest on Boeing. And take a look at how we're setting up for the market opens across Asia. We do have Japan coming back from a long holiday weekend. We had seen the Japanese yen pretty range-bound, and this after 3 sessions of gains for the Nikkei last week. Of course, the yen weakness recently had helped equity markets. We have seen the yen strengthen a little bit this week, but not so much, especially after the BOJ policy decision last week. And of course, the big one today, we do have the RBA rate decision as well. Sydney futures not really doing much at the moment, but the market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we continue to digest plenty of Fed speak overnight. Haidi, Fed officials leaving the door open for more outsized rate cuts coming from the Federal Reserve. The equal-weighted S&P 500 and the Dow closing at record highs.
Also waiting to see what more could we get out of China after that move to cut the 14-day rate, of course, largely seen as playing catch-up by the PBOC. We do have this rare gathering of the PBOC, the CSRC, and other financial leaders today, so we'll try and glean what we can in terms of policy signals there for broader support for the economy. And, of course, it is RBA decision day as well, Shery. No change expected, even as, of course, the rest of the central bank cohort moves to easing.
Yeah, and we had no change coming from the Bank of Japan last week as well, right? And after that rate decision from the BOJ, we actually saw a little bit of pressure on the Japanese yen, and we continue to trade at around that 143 level against the U.S. dollar. We are coming back from a long weekend holiday here in Japan, and you're seeing the Nikkei gaining more than 1% at the open. This after already 3 sessions of gains last week, so we're at the highest levels in about 3 weeks or so for Japanese equity markets. markets. We will be watching the Jibun Bank PMI numbers later today, and of course for a direction of where the BOJ goes from here. Also, we have Tokyo inflation numbers later in the week, a leading indicator of nationwide prices. But take a look at how Korea is coming online as well. We had some gains for the Kospi already. We're at the highest levels in a few weeks already for Korean stock markets as well. The Korean won sitting at that 13.35 level as we continue to get indications that exports continue to stay strong. Semiconductor exports especially continue to stay strong when it comes to really those early indicators on those export numbers out of the country. But Haidi, of course, all eyes today on the RBA.
That's right, and for a lot of different reasons, right? We're just looking at the potential signalling from the RBA, given that all expectations, and I think markets are only pricing in about a 3% chance of a cut coming through today. Broadly speaking, economists looking towards the end of the year, potentially going into next year before we start the start of the easing cycle here in Australia. A lot of that is really being to how inflation is still being propped up around 3% when it comes to housing prices in particular. Take a look at what we're watching today. Pretty flat start to trading at the start of the cash session for the ASX at the moment. The Aussie dollar are losing a little bit of ground, but we have seen that strength and that outperformance in the Aussie, currently trading at just about 68.31 cents at the moment. And a few factors pointing sort of towards the upside for the Aussie, right? Some of that stimulus and a monetary policy easing for China would be boosting, as well as these potential expectations of how that rate divergence continues to play out. Shery.
Haidi, let's bring in our next guest who says a weaker U.S. dollar is likely to benefit Asian equities. He favors cyclical North Asian markets such as South Korea and Taiwan. Kelvin Tai is regional CIO at UBS Global Wealth Management and joins us now from Singapore. Kelvin, great to have you with us. These are very tech-heavy markets at a time when we're seeing slight rotation away from mega-cap tech. So what do you think will continue to lead to support in these financial markets in Korea and Taiwan?
Well, I think a weaker dollar is actually crucial because I think the inverse correlation between the Asian equity markets and the dollar index has always been very, very high. So a weaker dollar will likely be beneficial for liquidity flows coming back into Asia. And therefore, in that sense, we do need the dollar to be significantly weaker before we can actually see inflection where these markets are concerned. And I think we're starting to see a little bit of that actually coming through with the Federal Reserve cutting by 50 basis points last week.
How much does that translate to really growth in economies across Asia? And what would that mean also for other smaller markets like Southeast Asia, for example?
Well, I think in the last 12 months, we've seen that the markets have actually been a lot more positive on the net consumer markets, like, for example, India, Indonesia to a certain extent, and the Philippines, largely because of the fact that, exports in the last 12 months have actually been weaker than expected. Global export trade volumes have actually come up, and so there was quite a fair bit of rotation into these net consumer markets. But right now, we do think that we're starting to see a rotation back into the export-heavy markets, like, for example, Taiwan and Korea as well, largely because of the fact that global export volumes are starting to actually trend up. Consumer sentiment in the US remains healthy, consumer spending remains healthy, and we do not see any weakness where retail spending in the US is concerned. That in turn should actually translate to pretty healthy export growth over the next 6 months.
The PBOC rate cut to the 14-day rate. We're also getting this pretty unusual gathering of economic and financial leaders today. What are you watching out for? And do you think this signals any more urgency than what we've had, over the past few months, over the last sort of couple of years of gradual, cautious support for the economy?
Well, the Asian economies have actually not been doing that badly. I think it's largely because of the fact that inflation has been high, rates have been high, and as a result of that, there's been quite a bit of pressure on the consumer side where Asia is concerned. But I think with the US now starting to actually cut rates, there is actually a greater impetus amongst the Asian central banks to actually cut rates as well. But the pressure on the Asian economies is not quite at the same level, largely because debt levels in Asia has actually been a lot lower. So where your coupon interest payments are concerned, most of the Asian economies are actually at pretty healthy levels, pretty low levels, in fact. And therefore, that's not a significant burden on the Asian economies going forward. And of course, with the US now starting to actually cut rates as well, a lot of the Asian central banks could potentially actually start reducing rates as well over the next 6 to 12 months. So I think that's an increasing tailwind for the Asian economies.
How much tailwind do we get for China if they do continue to move in this direction? And you talk about alpha opportunities at the moment. What would you be pointing those out as?
Yeah. I think China is a little bit more complicated because I think the pressure is actually not on the home buyer. The home buyers' balance sheets, the household balance sheets remain pretty strong. The pressure on the Chinese property market is actually with the developers. And, rate cuts of 10 to 15 basis points is not going to help them, largely because of the fact that, even if the rate's at 1 or 2%, for example, these developers cannot actually get financing. And that's where a lot of the logjam is, right? You need to actually ease that and actually be able to actually get the SOE banks or the finance companies to actually start lending to the property developers again before that can actually, before the easing of the property market can actually come through. But at this point in time, that doesn't seem to be happening. And a lot of the measures that the Chinese government have been talking about since March, during the third plenum and during the Politburo meetings, it hasn't really been actually implemented in a big way. And therefore, I think a lot of the home buyers, a lot of the investors are still pretty much not as optimistic about the Chinese property market as they were when they were talking about all these policy changes in that sense.
Would it make sense, though, to stay invested in China? And if you do, where would you go?
Yeah. I think on a longer term basis, certainly. The valuations are certainly very attractive. And the Chinese economy, despite all its troubles, will likely grow at between 4.8 to 5% this year. So I think on a medium to longer term basis, you do need to have exposure to China. But exposure to China can come in several ways, right? You can actually have exposure to the Aussie dollar, to the RMB, and to the Chinese bonds as well. And not just through the equities market. So on a medium to longer term basis, it does make sense to have exposure to China. But on a short term basis, I think the tailwinds are not going to be there. In fact, China might actually struggle on a short-term basis, given the fact that the policy reforms where the property market is concerned is not really biting into the market at the moment.
Kelvin, always great to chat with you. Kelvin Tay, Regional CIO at UBS Global Wealth Management. More ahead on the Asia trade. This is Bloomberg. Lebanese officials say nearly 500 people were killed as Israeli forces pounded hundreds of suspected Hezbollah targets in one of the deadliest days of fighting since the 2006 war. Monday's escalation is stoking now fresh concerns about a full-scale war in the Middle East. Bloomberg's Michael Heath joins us now with the details. And I guess that other side of it depends on if and when we see retaliatory action and what that looks like.
Yeah, the Hezbollah actually, when it fired some rockets towards Haifa, some of the reporting suggests that they were trying to sort of send a signal to Israel that, let's a warning shot sort of thing, that let's stop this here. But Israel has since escalated, and Israel seems to be determined to degrade the missile capabilities of Hezbollah. It seems to want to disconnect the conflicts in the north and with Gaza. Hezbollah's been sort of steadily firing missiles at northern Israel during the fighting in Gaza. That's forced Israel to withdraw, to take out move a whole lot of its civilians out of that area. And Israel wants to put them back. But while Hezbollah's on the border, while missiles are being fired, they can't do that. So they're using these strikes to try and take out as much of Hezbollah's arsenal as possible and perhaps do enough damage that Hezbollah pulls back, basically, because it doesn't want to lose everything it has. It's a pretty significant organisation there.
It's just interesting how quickly this has progressed with, as we were speaking yesterday, Gaza almost seems like in the background now. Western allies almost seem to be on the sidelines as well. Yeah, I mean, look, there's been some local reports that the US is basically not opposed to what's going on with Hezbollah. I mean, a couple of the senior Hezbollah figures that have been assassinated, presumably by Israel, were involved in attacks in the 1980s on the US. So these were wanted people there, and Hezbollah has violated the UN ceasefire, where it's supposed to be further back away from the border.
So Israel's not really out of it's not straying too far here. The problem is that it's attacking houses where it says there are missiles located and based. And obviously when that happens, you're not always going to have the right intelligence. Accidents happen, civilians get killed, and again we see this cycle of innocent people suffering in this sort of wider campaign. But yeah, you're right. I mean, to some extent the international opinion has been sidelined, and we've just moved so fast from one conflict to the next. So Gaza is still bubbling away.
And we've just heard from the president of Iran as well, wanting to de-escalate tensions.
Yeah, I mean, he said that, I mean, he's newly elected, and he said Iran's prepared to put aside its weapons if Israel is. I mean, in fairness to that president, he doesn't have a huge amount of power, despite being called the president. Obviously, the supreme leader in Iran calls the shots there, and there's significant groups within the military that deal with the proxies like Hezbollah and Hamas. But it's a slightly disingenuous thing to say. I mean, Iran basically finances and supplies the weapons to all of these groups, whether it's the Houthis in Yemen or Hezbollah in Lebanon or Hamas in Israel. So it has a lot of leverage there to pull them back. So Israel seems to not be taking too much notice of that, and is basically determined to sort of degrade the power of Hezbollah. But again, it will be interesting seeing all these people rub shoulders during the meeting in New York.
Bloomberg editor Michael Heath there. And staying with geopolitics, the U.S. is seeking to ban the sale or import of Chinese and Russian-made hardware and software for connected vehicles, citing national security concerns. For more, let's bring in our China correspondent, Min Lo. Min, of course, we know that these days, really, cars are more than just cars. They're mini computers on wheels, basically, at this point. So how significant would the impact of this be on these connected vehicles?
Well, the software ban, if it's enacted, it will kick in 2027, and the hardware ban by 2030. So the immediate impact of this essentially is to ban any Chinese cars making use of these Chinese software or hardware from having any footprint in the U.S. as well. It essentially cuts off that backdoor of Mexico, which was one way that Chinese car makers could explore exporting cars into the U.S. under that North American Free Trade Agreement. But with this proposal enacted, then that backdoor would be closed as well. Now, Gina Raimondo, the Secretary of Commerce, had said that this is a proactive policy, given that there are currently very few Chinese or Russian-made cars on U.S. roads. But she pointed to the EU as a cautionary tale, saying that this policy needs to be set up before it becomes a significant threat, because we know in the EU, China imported cars from Chinese-owned brands make up about 7% of the electric vehicle shares in the EU as of last year. Now, some analysts are saying that this could be a slippery slope as well. If China's technology is so dominant in the world's consumer products, if it's okay in a TV, it's not okay in a car, then where do you really draw the line? So that is the big question here. But obviously, Biden is likely looking to enact this before he steps down in January.
And a bit of a win for Beijing. They've successfully managed to push forward this dispute panel at the WTO reviewing the U.S. Inflation Reduction Act, I should say. It's really, the accusation of being this is protectionism under the guise of climate change action.
That's right. And this is China's second time in trying to establish this panel at the WTO. The first time they did it, the U.S. had blocked it successfully back in July, saying that the Inflation Reduction Act, excuse me, the IRA, they are saying that it is essential for climate change. And this IRA is, by the way, President Biden's flagship industrial policy that provides for over $370 billion in provisions, climate provisions, including tax credits for electric vehicles and incentives for renewable energy projects. And China is saying that it is discriminatory against Chinese products because of the rules around domestic content requirement. And so the WTO will now have to investigate whether the IRA actually violates international trade rules. And of course, Washington has hit back, saying that China is just using this to distract from its own unfair trade policy that they say include weak environmental protection and forced labor as well.
Bloomberg's China correspondent Min Lo there. Well, of course, we're watching the RBA with the central bank here in Australia expected to hold rates steady today. Housing costs, including rent, continuing to drive inflation concerns. Our economics reporter, Swati Pandey, joins us now. So still a whole lot more hawkish, and that's sort of even in starker relief after the jumbo-sized move from the Fed. There's only a 3% pricing when it comes to a chance of a cut today. Is this all down to the housing crisis?
Housing is a really big part of this problem that we are facing right now. Our inflation is proving to be stickier and more persistent. Housing costs are the biggest driver of inflation at the moment after services, and that is rent, which is quite high and rising still. We have electricity prices even after the government rebates still strong, and then the cost to build a new home, that is really, the costs are really proving persistent, and that is because of a skills shortage, even though we are seeing growth in population and migration, but it's not coming down to resolving the skills shortage problem that we have in the construction sector.
So this is a confluence of factors that are quite unique to Australia's economy at the moment in terms of, you know, obviously there's been a global battle in this cycle.
That's right. I mean, policymakers have said that this last mile of inflation is proving to be a challenge, and other central banks are seeing in their data that inflation is coming off, moving in the right direction. We have not quite seen that in our case yet, and it's also domestic services inflation which remains quite strong, and government fiscal policy is strong as well. So government is continuing to strong. We all got tax cuts in July. There's rent relief that people got in July, as well as electricity rebates. There's also a lot of infrastructure spending by government, which is all boosting the inflationary impulse in the economy.
How much nuance is there expected to be in terms of the communications today?
Look, it's going to be really challenging for Michelle Bullock to continuing to deliver that hawkish language, right? Especially when we are seeing it not just globally, but also in our region, right? In Indonesia, China, like, you know, countries around us are cutting interest rates as well. And the Fed went by 50 basis points as well. So that is
and there's
really,
political pressure too.
That's political
so much
pressure.
Noise.
That's true. That is going to be really challenging for them to continue to sound hawkish, and especially the last monthly inflation gauge that we saw was moving down, and then we have inflation report tomorrow, which is a monthly indicator as well, and that is going to be under 3% for the first time since August 2021. So in light of that, it's going to be challenging for Michelle Bullock to continue to say that we are not ruling anything in or out. There could be an interest rate hike as well. You know, brace for more pain. It's really going to be challenging.
It's the threading the needle piece of the bingo card, right?
That's right.
Our economics reporter, Swati Pandey, there ahead of the RBA decision. And Australia's economy and migration policies, of course, firmly in focus. Swati was just touching on those factors, and that's going to be the focus of our Australia Ahead segment. The former Deputy Secretary of the nation's Immigration Department joins us live for that conversation. Shery.
And Haidi, take a look at some big moves for this Japanese drug maker, Daiichi Sankyo, now at the lowest level since April of this year. And we continue to see those losses at one point of more than 6% after AstraZeneca said that an experimental cancer drug that it's been developing with Daiichi Sankyo did not actually help breast cancer patients live longer than chemotherapy. So that drug, known as Dato-DXd, was probably muddied, and the results from those tests were muddied because patients went on to try other effective therapies after their cancer got worse in the trial. So we're now seeing Daiichi Sankyo at the lowest level since April of this year. We have more ahead. This is Bloomberg.
If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.
Momentous as the recent decision to begin removing restriction from monetary policy was, taking that step does not lock us in a cadence for further moves. I think it's important that no one think that we're in a mad dash to get to some neutral level. Given the amount of uncertainty in the economy, being more patient will be valuable.
Fed officials there on the bank's rate path. Let's now get to some market calls we're following today. Goldman Sachs has lowered its forecast for the dollar against a wide range of currencies. That, of course, after the Fed slashed interest rates. The bank now expects the greenback to gradually weaken as lower U.S. yields diminish its appeal. In turn, Goldman has lifted its forecast for several major currencies, including the euro, the pound, and the yen. The call for a broadly weaker dollar, contrasting with that view from Deutsche Bank, which sees the Fed's easing doing little to shake the U.S. currency. Now, JP Morgan is seeing global companies and financial sponsors exploring both M&As and IPOs in India, given the country's economic growth. Their head of investment banking in India says financial services, including insurance and banking, are attracting a lot of interest. Separately, JP Morgan's global head of capital markets says that EM portfolio managers are looking to allocate Haidi more capital to Indian markets.
Shery, let's get some of the stories that we're following when it comes to corporate headlines today. And Bloomberg has learned that the U.S. Justice Department plans to allege that Visa allegedly monopolized the U.S. debit card market. Sources say the DOJ Antitrust Division is set to file a lawsuit as soon as Tuesday, accusing the operator of the largest U.S. payments network of a range of anti-competitive conduct. This would be the culmination of years-long probes of Visa's business practices. Anthropic, that's OpenAI's largest rival, has started talking to investors about raising capital in a deal that could value the startup at up to $40 billion. Sources say this would roughly double its valuation for funding that closed earlier this year. The Anthropic talks are ongoing, and it's not clear whether investors will agree to such a high valuation. Anthropic declined to provide comment. Germany says it opposes a takeover of Commerzbank as Italian lender UniCredit moved to raise its stake. German Chancellor Olaf Scholz criticized UniCredit's unfriendly attacks hours after the lender disclosed derivatives contracts allowing it to boost its Commerzbank holdings. That effectively makes the lender of the biggest shareholder ahead of the German government and on course for a takeover, Shery.
Heidi, take a look at how European futures are trading in the Asian session. We had seen small gains overnight after we got some weak PMI data for France and Germany. That was followed by numbers that showed the euro area's private sector economy shrank for the first time since March. So the euro also slumped, and perhaps with more expectations that we could see more easing coming from the ECB. European stocks edged toward an August record high as investors weigh the outlook for growth and, of course, monetary policy. We're seeing that broad upside right now in Asian futures trading at the moment, of course, especially after those gains that we saw on the Wall Street session as well. We have more ahead on the Asia trade. This is Bloomberg. We have breaking news out of Japan. We are getting the Jibun Bank PMI numbers. For the composite figure is 52.5 for the preliminary numbers for September. We're still in expansionary territory for a third consecutive month. PMI for the manufacturing side of things, we're still in contraction territory, 49.6. We have been really fluctuating between contraction and expansionary territory for the manufacturing PMI numbers here in Japan. For the services data, still in expansionary expansionary territory at 53.9. We've been following the manufacturing sector very closely. Overall, across Asia, we have seen manufacturing activity being pretty sustained, especially since we got South Korea early trade numbers and really showing those new orders are still solid. But we'll continue to watch those numbers out of Japan because they've been fluctuating in that 50 threshold right now for September, preliminary at 49.6, Heidi.
Shery, take a look at how we're trading when it comes to, of course, Japan coming back online, a little bit of catch-up, or in some sectors it would be a catch-down, particularly when it comes to that weakness in tech. But at the moment, we are seeing broad upside. The Nikkei 225 up by about 1.6% there. The Kospi also seeing a little bit more muted in the way of gains, really following Wall Street peers higher after we heard from several Fed policymakers hinting at further possibility of easing. Some more optimism when it comes to China as well. That's been sort of weighing on the Aussie market on RBA Day, no less. We're expecting no change. Of course, that hawkish hold. It'll be really down to how Governor Bullock chooses to communicate that, given, of course, that the starkness of the contrast between where the RBA is at and where other central banks, including the Fed, is at in this easing cycle. But, of course, the big move from the Fed, the expected weakness for the US dollar and what that means for emerging markets have really created quite a bit of optimism when it comes to risk assets in EMs. Take a look at the latest analyst call from HSBC for one example. We're seeing they've downgraded Korea stocks to underweight from overweight. On the other side of the spectrum, they've lifted Indonesia to overweight from neutral, as well as raising Malaysia and Philippine stocks to neutral as well. It's interesting because we have seen the likes of JP Morgan recommending to lock in some profit given the strength of the Indonesian stock rally that we've seen so far, but the outlook is still really broadly positive. We have also seen the Philippine stock market there just on Monday, in fact, closing in bull market territory on prospects of further monetary policy easing in the US and also in the Philippines as well. When it comes to some of these other emerging market assets, we're seeing that rush to emerging market bond ETFs, not to mention a lot of upside trading in EM currencies as well. And it's interesting when you take a look at that, perhaps a little bit more correlation across the EM complex than what we're seeing out of China, right? Traders are being hopeful, a little bit more China stimulus maybe on the cards. The PBOC calling a rare news briefing due to begin in the next hour. That's after the central bank, in some respects, surprised markets by cutting one of its short-term policy rates. From all, let's bring our news desk editor, Jill Deesa. So, Jill, the cut to the 14-day rate was in a lot of respects sort of playing catch-up, right, after the move back in July. But when it comes to this news briefing, I'm a bit more intrigued about that. What could we see from the PBOC, the CSRC, and some of these other policymakers today?
That's right, Heidi. So there's a couple of reasons why investors are so interested in this upcoming briefing. It's really due to kick off in just the next 30 minutes. So first of all, it's PBOC Governor Pan Gongsheng, as you said, joined by securities regulators, some other officials here to talk through policy. It's a bit rare that they would set a meeting, first of all, this early, right? Because normally you see Chinese officials meeting around 10 a.m., but the fact that this meeting is happening at 9 a.m. local time, this press briefing, has kind of led to the speculation that maybe they're going to be cutting some additional rates. It's about 20 minutes before they set more short-term policy rates. So in addition to that rate that was just cut yesterday, as you said, kind of playing catch-up there with some cuts that were made earlier this year, maybe this is a chance for them to announce some additional things, whether that's cutting reverse repo rates, 7-day rate. Maybe they're looking at another cut to the reserve requirement ratio. I'll point out to you, Heidi, that earlier this year, I think it was around January, you had Pan Gongsheng, the PBOC governor, kind of come out and make a surprise adjustment to the reserve requirement ratio for major banks. That's how much cash they have to hold into reserve. That idea there was to stimulate the economy. So maybe we're getting something along those lines. It's tough to say right now because it is China, so you don't get a ton of transparency ahead of time there. But yes, the timing of this particular meeting is of quite a lot of interest right now.
Jill, I gotta be honest, I'm losing track of everything that Beijing is trying to do to stimulate its economy. Putting everything into context and given everything that you've seen so far, whether it's a monetary or fiscal side of things, where are we in terms of the growth trajectory for the rest of the year, especially the fourth quarter, because they have to supposedly attain that 5% growth target, right?
Right. Well, I'll tell you, Shery, as of right now, I think it's broadly expected among a lot of economists that China is not on track to hit that growth target of around 5%. We just got a set of pretty dismal data for last month that didn't really do a whole lot to gin up a lot of confidence in spending in particular. That's obviously been a huge pain point for the Chinese economy over the last couple of years. Now it does look like they're probably going to miss that growth target this year. What does that mean in terms of stimulus? Well, you know, as we've seen over the last couple of years, China has been really, really reluctant to roll out anything that I'd consider sort of heavy stimulus, this bazooka-style stimulus that a lot of economists have referred to, whether that's really, really deep cuts on the monetary policy side, whether that's a lot of big fiscal spending. I'm not sure that China really has the impetus to boost stimulus in a really, really massive way. But there are some things that they have done that I'd say economists have looked at and said that's really, really where the bulk of the sort of the help for the economy can really come from. I think a lot is really pointed to this housing policy package that was rolled out earlier this year to sort of rescue the market, whether that was relaxing mortgage rates or actually encouraging local authorities to buy up unsold homes. That program hasn't really taken off, but maybe there's some measures today that the central bank could announce to try to help boost the effectiveness of that program, really kind of try to turn around the property sector, which, as we know, has really, really been at the heart of a lot of the slowdown over the past few years.
News Desk editor Jill Deasy is there with a preview of what to expect from China and, of course, the continued slump that we're seeing in the Chinese economy. That's also leading to a slump, of course, in Chinese equity markets and stock pickers now having lost $312 billion in assets. This as we continue to see the surge in exchange-traded funds, making passive investing an influential force in the Chinese market as well. For more, let's bring in Asia Stocks reporter Jeannie Yu here. And Jeannie, of course, we have seen really the exuberance over passive investing just globally. On top of that, of course, we have the continued equity slump in China because of the lack of confidence there. What's been really the fallout when it comes to these stock pickers across China?
Yes, exactly. Like you just mentioned, actually over the past 3 years, we have actually observed a very interesting change, which is like for China, which has more than $8 trillion assets. Actually, people are turning more and more to passive investments. And I think the driver not only include those retail investors who actually favor more towards active investments in the past, but also including those national team, those state-backed institutions. When they want to step into the market, they would use passive investing as their first primary investment vehicles. And in terms of the data, we have seen like passive investments in terms of all the ETF assets now actually account for like almost half of China's total market cap, and versus US has about like 58%. So that ratio is narrowing, and this ratio in China actually more than doubled in the past 3 years. So you can tell like how cautious and like those retail investors has become, and how much efforts those national team has piled into the markets, like trying to rescue the market slump. So which is a very interesting change in the China market nowadays.
Yeah, it's interesting. Is there any expectation that we could see, a return of some of these, the brightest stars when it comes to the stock picking universe? Or is this really kind of the realistic acknowledgement that the invisible hand of the state has a much bigger role to play, and the safer way to play that is through these ETFs?
Yeah, I think so. When we talk to investors, I think the overall sentiment is still very, very cautious, especially like for many investors, they have a lot of recency bias, which means like they have lost a lot of their active investment money over the past 3 years. So if you see like all the so-called star fund managers in mainland China, many of them actually lost a lot of money, and a lot lot of people like actually try to have some, like they were under like some social media pressure because their fund was not performing really well. So instead, I think this growth in the passive investment would continue to grow. Like maybe there is a potential for the passive investments to surpass the active investments in China.
Our Asia Stocks reporter, Jenny Yu there. Another story that we're following at the moment, the trial of Singapore's former transport minister is due to begin today. S. Iswaran is facing 35 corruption-related charges, including allegations that he obtained more than $300,000 in luxury goods. The case has become the biggest political scandal to hit a city-state that prides itself on zero tolerance against graft. Iswaran has pleaded not guilty to all charges. And do stay with us on Bloomberg Television for our coverage of JP Morgan's annual India Investor Summit in Mumbai. You can catch our conversation with the bank's co-head of payments, Max Newcochin, and the co-head of global banking, Filippo Gori. Those times are on your screens. More ahead on the Asia trade. This is Bloomberg.
That is my job, and our job is to make sure that people in New Zealand see that there's a massive opportunity here, that actually it will be a safer community, it will be a place where there is higher levels of economic productivity, so if you work hard you can get ahead, that if you need public services around education of your kids, access to healthcare, that all of those things are upgraded. And that's why our government's been very fixated on a pretty simple plan: rebuild the economy to lower the cost of living and get the growth conditions in place, make sure we restore law and order and deliver better public services, particularly in the areas of education and health.
New Zealand's Prime Minister Christopher Luxon there speaking to us exclusively last Friday. And to the PM's point, a new survey shows that New Zealand workers are more pessimistic on the jobs market amid an economic slowdown. The Westpac McDermott Miller Employment Confidence Index has fallen to its weakest since 2020. And over the past 2 years, more New Zealanders have left for Australia for better opportunities in the face of a cost of living crisis. Let's put this story into a broader context now. Bloomberg's Paul Allen joins us, along with our Australia and New Zealand economist, James McIntyre. And Paul, I'll start off with you. And, you know, it's interesting, of course, because you are a New Zealander who has been in Australia for a long time. In that sense, the sort of brain drain across the Tasman is not a new thing.
No, it's not. It's been going on for a really long time. And Chris Luxon there is just the latest New Zealand Prime Minister who's had to grapple with this problem because it boils down to, as he said there, opportunity. The simple bare fact of the matter is that you can earn more money here as a New Zealander, so people tend to follow the money. There's a cheaper cost of living as well. Fuel, electricity, food, it all costs less. And it's so easy because New Zealand and Australia have a reciprocal agreement. Each can work in the other's country with no paperwork. You get a visa on arrival. It's all paperless. All you need is a tax number and you're pretty much good to go. So a lot of New Zealanders afford themselves of that opportunity. But as I say, it's been going on for ages. There's a famous quote from the former Prime Minister Robert Muldoon back in the 70s and 80s where he said, New Zealanders that leave for Australia raise the average IQ of both countries. Cracking joke, holds up after 50 years, but the problem's also still there after 50 years. People just leave for the opportunity.
And, you know, in that conversation with the Prime Minister, there was this overwhelming sense that he's really trying to get animal spirits back into the Kiwi economy, right? If you compare the two economies, are the opportunities for Australia, you know, that much more outsized?
Well, I guess, look, what you've got here is you've got two economies, different exchange rates, different monetary policies, but an open labour market. And so you've had the RBNZ that's gone very, very hard, very aggressive in its inflation fight. And we've got, you know, we're now entering that triple dip recession in New Zealand. So yeah, it's going to be very hard in that labour market to get any sort of opportunity going through. Whereas the RBA has taken many have cast lots of aspersions on it, but taken a slightly more softer stance when it comes to monetary policy and been prepared to let inflation glide down a bit more slowly. And that's meant that they've kept that labour market a lot more intact. And so when you've got that open labour market, when the opportunities are there, and when, you know, this is not new for New Zealand, there's a 30% pay increase when you come across the Tasman to come and work in Australia. That attractiveness is there when the jobs are not in New Zealand. So, you know, there's a lot more work that Luxon, but also the RBNZ, have got to do.
And of course, when we talk about skilled migration, it's a key component to productivity, to growth and prosperity for Australia. But there's also the element of how much pressure it's putting on the inflationary side, particularly when it comes to net migration and dwelling costs.
Yeah, absolutely. And Australia's got a problem in terms of its net migration, and it actively recruits New Zealanders in some professions like nurses, teachers, also other skilled professionals, police, and it does so with cheeky campaigns, usually based around the weather. But then when you get here, you have a problem. You have to find somewhere to live. Now, rental rates in Australia are at record lows, hovering around 1.39%. We've done a few stories on that this year. And the government's trying to address that here in Australia with Help to Buy schemes, supporting home buyers with the smaller deposits, having a lot of trouble getting that through Parliament. The Greens want more done, including winding back tax breaks like negative gearing, and the Liberals at the other end of the argument say, well, look, the government shouldn't be in the business of co-owning homes with people at all. And then you've got pressure from another sector as well, which is the tertiary education industry, which makes billions for Australia. But at the same time, foreign students put pressure on housing. So it really is a wicked problem for the government.
I want to get your answer on this because on the balance of things, do you think migration as being an issue, is that a sort of a straw man fallacy argument, or do you think it will meaningfully take the pressure off the housing market if net migration is reduced?
I think what we're dealing with the housing market is the fact that the borders were closed for a year or two, Airbnb stopped existing, and everyone, especially in Sydney and Melbourne, got used to these apartments being available. And so instead of having to have a flatmate or stay at home, you could get a two-bedroom, a bedroom for you and one for your work-at-home office. Now, when the world came back online after the pandemic, we all had to get back to reality, and the noise and the pressure in the rental market is part of that. It's not just migration coming back online. We're getting everyone stacking back into housing the way we used to, and we're almost back to the same number of people per household that we were at before the pandemic. Low vacancy rates, high rents, that's what makes people make those decisions. I don't necessarily think it's a problem of migration. If it is, get a Kiwi as a flatmate and that'll solve the rental problem pretty quick.
How risky is this sort of conversation though? Because we know with the natural rate of population growth shrinking, Australia is going to need migration to be able to keep up prosperity, not to mention diversity, right, but certainly economic growth.
Well, it's not just the economic growth that migration has really helped with Australia. What we do is that, across advanced economies, across the OECD, ageing populations, shrinking workforces, that's a reality for many economies, and it's not here in Australia. And that's because of this migration program. The average age of the Australian population is around 38, but the average age of our migrants is around 30. We keep pushing these people into the population, and it really prevents us from having this ageing population that, when we think about intergenerational reports that have been published over the last 20 or so years, said we were going to have a massive problem, all because they think that our migration is going to go back to a low level. If we keep it as it is, we keep pushing that problem away and making it other people's problems while we get to enjoy relatively strong growth here.
Bloomberg's Australia and New Zealand economist James McIntyre and Paul Allen here as well. We do have more every week on Australia Ahead, Tuesdays at 10:40 a.m. in Sydney. This is Bloomberg.
We have an alert on the Bloomberg right now. We are getting the response from Boeing's largest union after the plane maker offered workers a 30% wage increase. They're saying that Boeing refused to meet the union for further discussions, that the union will not be voting on September 27th. And the International Association of Machinists and Aerospace Workers now criticizing Boeing for the way that it's offered this bid, which was a 30% wage increase over 4 years, up from 25% increase, which was turned down earlier this month. Take a look at how Japanese assets are trading at the moment. We're seeing broad upside right now after markets came back from holidays. We are talking about the Nikkei gaining more than 1% and the Japanese yen holding steady at that 143 level. We have seen some downside pressure for the yen after the BOJ held policy steady. Now, top executives at KKR and Blackstone say private equity is in its infancy in Japan, and there is ample room for buyout firms to expand their presence. Blackstone President and COO Jonathan Gray spoke at a Bloomberg event in New York, along with KKR Co-CEO Joe Bae.
We're quite bullish on Japan. I mean, Japan is a must-own country today for investors. The key, as my panelists have said, is the continuity of these reforms, the continuity of these policies. That's what investors really need as a foundation, right? Is stability, transparency, and continuity so they can invest for the long term in a country like Japan. But we're very, very bullish.
What are you, I mean, is it a crowded space for private equity at the moment in Japan?
I think there have been a lot of articles of the growing demand for private equity in Japan. But when you look at the US or you look at Europe, private equity in Japan, it's at its infancy, honestly. There are much fewer players, probably less than 1/10 of the competition that we face in other markets. So there's a lot of room to grow. The private equity industry will grow also as the capital markets in Japan continue to diversify. Japan today is very much a bank-led economy, right? The main banks in Japan, the regional banks. You don't have the same sort of capital markets in terms of the bond market, high-yield market. That's going to be a huge enabler of private equity and the types of transactions we do. And private credit is a whole different asset class, which really doesn't exist in Japan today. So there are multiple legs, and you could see that could really accelerate the development of private equity over time.
John, do you agree with that? And do you worry about bidding wars if more players come in?
Well, there's always competition. You'd love to be in a market where there isn't, but we live in a world where people see opportunities. They get on planes, they build their offices on the ground. But I agree that relative to what we see in the U.S. and Europe, it's still early days in terms of private asset investing in Japan. And the number of players relative to the scale of the economy is still pretty small. So we think it's a pretty favorable dynamic as an investor. And it also feels like it's early days because these reforms have only been in place for a short period of time. And people are excited that the Japanese stock market is above the 1989 level. But think about where that is relative to other markets. And you think about the long-term potential. And you also think about Japan's strength in technology in the world we're moving into. So we have a lot of underlying bullishness around the economy. The fact that the market's opening up and there are a limited number of players on the ground, that all seems to us to be a very good dynamic. And so we want to deploy more capital, have more people there, and generate favorable returns. So it feels very good to us early days. And I would also say we hope these reforms stay in place and they continue.
We are, of course, looking ahead to this joint media briefing in Beijing, including speakers from the likes of the PBOC, Pan Gongsheng, the governor there, the CSRC chairman, Wu Qing, as well as the National Financial Regulatory Administration chief, Li Yunze, as well. Expectations are high for some sort of announcement on economic support.